Like if I have a single family residence, what can I exchange that into?
So I can go from a single family rental to, depending on the value of the property, obviously, but I could go into a single tenant triple net. I can sell an apartment building and I can buy an industrial building.
What is really the basics of a 1031 exchange?
When I sell a property, how much do I have to buy in order to defer the tax?
This is how wealth stays within families because of tax laws like this. So, yeah,
Yes.
it's a beautiful thing. Welcome, everybody, to the Sean San Jose podcast. I'm super excited to have our guest. She is an absolute expert in her field in 1031 exchanges. If you don't know what 1031 exchanges are, you're about to. I'm super excited. She's been in the business for over 20 years with asset preservation. We have Dino Champagne. How you doing today?
I'm doing great, Sean. Thank you
Good.
for inviting me to chat on this topic. I appreciate it.
Absolutely, absolutely. I know you've brought in a lot of value to myself and others in the past, hosting classes and whatnot. So it's an honor to have you on the show. I appreciate your time today.
My
So
pleasure.
yeah, let's jump in it. So, a lot of people don't know what 1031 exchanges or they've heard it, and there's a lot of misconceptions about it. They don't know exactly how it works. So, what is really the basics of a 1031 exchange?
Okay, so let's just start a little bit about why, what is a 1031 and why it's valuable for investors. A 1031 is actually a part of the Internal Revenue Service tax code itself. So, sometimes people think of a 1031 as some kind of a loophole, and it really isn't. It's a part of the code. And it's been around for over 100 years now. So this has been a vehicle where investors and people that own property that they operate their business out of are able to sell that property, defer the tax, and go off and buy, more property. So it's a tax deferral mechanism. And so in order to do that, there are certain timelines and guidelines that an investor or a business owner, if they're selling a property where they're operating their business out of, have to meet. So regrettably, you don't have forever to do this. So there are specific rules and guidelines. I like to say that the four basic guidelines is: one, does the property qualify for a 1031? So has the property been held for trade or business or for investment? The next requirement is going to be how much you have to spend for a 1031. So we call that the exchange equation. So that guideline means, when I sell a property, how much do I have to buy in order to defer the tax? So the quick answer to that is that an investor needs to purchase property equal to or greater than their sale price minus the closing cost. They must spend all of the cash. And if they had any loans on the property, those loans have to be replaced.
So you mentioned like tax deferred, like you're deferring the tax until a later time. Is that correct? So
Yeah.
you don't get away with not paying taxes. They're gonna get you eventually.
Well, for the most part, yes. However, if an investor continues to do 1031s until they pass away, then, under current tax law, there's what's known as a step up in basis. So when the heirs inherit the property, there's going to be a new market value assessed to the property. And then any gain, any tax on any gain that the deceased, if you will, has been deferring under current law is not passed on to the heirs. So that would be the one time where that tax liability is not being imposed on any of the heirs. But
Awesome.
You're right. What you said initially is that if you're just kicking the can down the road is probably an easier way to put it.
Yeah, and
So,
this is how wealth stays within families because of tax laws like this. So, yeah,
yes.
it's a beautiful thing. I mean, for families that can hold on to properties, and I know there are limits to how much as far as gift tax once you exceed a certain amount, and then the heirs will pay taxes above a certain amount. I'm aware of that, but typically most common families won't reach that level of wealth. So yeah, it's an absolutely great tool. And the other thing is that I've realized is with depreciation on the assets, sometimes it makes sense to purchase something that's more expensive in order so they can actually write off more on the rental revenue that comes in, right?
Yeah, what you're touching on is what's known as the replacement property basis. So when you're doing an exchange, an investor needs to view it as a continuation of ownership, albeit with a different property in a different location, right? Or different properties in different locations. So you can buy multiple properties in exchange. So if somebody has owned, say, a single family rental for 25 years, under the current depreciation schedule, you have 27 and a half years. So that means if I've owned a property for 25 years, I'm down to the end of my depreciation. If
Sure.
I buy a property that's the same value I sold for, I'm not getting any new depreciation schedule. But like you highlighted, if I buy a lot higher, now I'm going to end up with two depreciation schedules. One that's going to track with the original basis, and a new one that's going to track with the increase basis because I bought higher than what I sold for. So 1031s, especially if you're using depreciation as a good vehicle to shield any tax liability for the operation of the property, buying more in a 1031 is going to be should be your friend.
That's awesome. Yeah, yeah, there's all kinds of fun stuff, right? When it comes to real estate and ways to shelter tax. So that's why it's a great vehicle and a lot of people end up investing a certain amount of their portfolio into real estate. So yeah, you started to mention there's four different aspects and one was the does it qualify? So let's talk about that. What qualifies for a 1031? Like if I have a single family residence, what can I exchange that into and kind of break that down for us?
Okay. Yeah. So that's the property qualification. So the first thing to be aware of is that when you're doing a 1031, first of all, it has to be real estate. Okay. So there's no personal property or anything like that. Has to be real property that you're exchanging. Now, what you're describing is known as what's called like kind property. All right. So what qualifies as like kind property in an exchange? Sometimes people think that if I'm selling a single family rental, I must buy a single family rental. Or if I'm selling farmland, I must buy farmland. Well, the reality for a 1031, and this is the good news, is that when you think of a 1031, your investment needs to be property that you held for trade or business or for investment, real property. And you just have to buy property that you intend to hold for trade or business or for investment. So I can go from a single family rental to, depending on the value of the property, obviously, but I could go into a single tenant triple net. I can sell an apartment building and I can buy an industrial building. I can sell an office building and buy a whole bunch of single family rentals. So when you think about a 1031 in like kind property, just think of it as investment real property for investment real property. Okay.
That's awesome. Yeah, so that's huge because that makes it very diverse and it's always a little bit confusing. Like you mentioned, I have the single family, but there's this beautiful 20 unit apartment building I have my eye on, and I can
Mhm.
actually make that happen. So
Yes.
that's a very neat tool. Number two, you mentioned how much can you spend or how much do you have to spend? We would love to hear a little bit more about that.
Sure. We call that the exchange equation because the government wants you, like I mentioned, continuing the ownership. So when you're doing a 1031 to defer the gain on the sale of that property, you must purchase property or a combination of property. So doesn't necessarily have to be one for one. It could be one for two or three. Okay. So you must purchase property equal to or greater than your sale price minus the closing costs. The closing costs I'm referring to are going to be commissions, title, transfer tax, escrow fees, accommodator fees. Those are considered acceptable expenses in the transaction. You must spend all of the cash coming out of that sale And if there were any loans that you had on the property, that loan or loans must be replaced. So for example, if I sold something for 450,000 and my closing costs were 50, I need to buy property minimum of $400,000 and
Gotcha.
spend all of the cash. So that's how that works.
Makes sense. Makes sense. So, what happens, let's say, if you buy, it sounds like you could buy two properties, right? So, if you netted 400,000 and you found two properties that were each 200,000, that would qualify for how much you spent.
Yes, yes, exactly. So as long as you're spending all of your cash, yeah, that's totally fine.
What?
And then you can decide as the investor how much money you want to put down on each one of the properties. So you're not mandated, say, well, my cash is, I have to split my cash 50-50. You can buy one property depending on your circumstances, all cash, and then you can get financing on another. So it gets down to the investor, and then this is where you'd be coming in, to figure out the ownership strategies, the investment strategies, the returns, if you will. What's better for the client, put more down on this property, less down on this property because the cash flows better. So you get to carve out how you want to spend all that money, you
That's
know.
awesome. Yeah, so it's not a set amount on how much down to each property, and that may make more sense to put more money down in an area that doesn't rent as high, and maybe you find another property that rents are a little bit higher. You don't have to put as much down to make sure that they're either at least debt servicing or have a little bit of positive cash flow. So
Exactly.
yeah, and
Exactly.
then as far as like proceeds, my understanding is that you cannot, all this money has to go into one account, and from that account has to go into the next property. There's you can't take money out of that account and put it in your bank account, can you?
No. Yeah. So when you're doing a 1031, you have to have a qualified intermediary. That's our function in the transaction. So you're going to do your job as, listing the property, selling the property, helping them buy the replacement property and such. But when you're doing a 1031, the taxpayer, the investor, cannot touch their money. So the exchange is set up prior to the closing of the sale. So there's documents that have to come in that have to be signed to the closing, prior to the closing. When the buyer brings in their funds, obviously loans paid off, closing costs taken out, the balance of those proceeds have to come into the exchange. If the taxpayer or the investor wants to keep any money out, then that portion's going to be taxable.
Okay.
It's going to be
So
taxable.
so you can take a small, whatever portion you take out, only that portion will be taxed, correct?
Correct. Correct.
Yeah, that's
Mhm.
interesting thought, because that might be a play as well, where you might want to take some money aside, and I don't know, maybe you have a different business venture you may go after, and that way you still can protect a lot of the gain and still utilize and only pay a little bit of gain on the portion that you take away. So that's a good clarification, because sometimes people think that if you take a little bit, you have to pay capital gains on everything, and that's not the case.
That's correct. Yeah, it's not an all or nothing system. Okay. And there may be instances where the investor, may have some suspended losses or something, that taking some cash at the closing, they can free up some money because they have some losses that can offset the tax on the gain for that portion. I would say when you're considering doing a partial exchange, because that's what we're describing, when you're considering doing a partial exchange, it's really important to understand what is your actual gain dollar amount on the sale of that property, and will you still be benefiting from the exchange because if you take out too much cash. So for an example, if somebody has gain on the sale of a property that's $100,000, now they're doing the exchange and they go, well, I want to keep $50,000 cash. All right, that 50,000 is going to be taxed. You're still protecting tax on the other portion of the gain. But if they wanted to take out $100,000 and that's their gain, then there would be no reason to do the exchange because they're going to pay the tax like nothing happened. So
Sure.
anytime you're considering a partial exchange, you need to know what's your what's your capital gain dollar amount. And then that determines whether you're still benefiting from an exchange or not.
And then I think a solid question is when you do a 1031, I know that's a federal thing. How does it affect California if you're in California or whatever state you are? I know we're in California, so California specifically, do you still owe California franchise tax board?
Fortunately, California does comply with the 1031 code. Most states do. There are a couple of states that have some nuances, but California does. So when you're selling, you're not only deferring federal tax in doing an exchange, you're not only deferring federal, but you're also deferring California state tax.
Wow.
Now there's a nuance though, that if an investor sells in California, and then they, find the replacement property in, say, Texas or Florida or Arizona or Tennessee somewhere, you're still deferring California tax, but there's a reporting requirement every year in perpetuity that you own those properties that you bought, showing that you still own them, and therefore you do not have to give California Franchise Tax Board, any tax for California. So if you fail to do that, then the California Franchise Tax Board will be sending you letters saying, you didn't do the annual reporting when you filed your tax return, so you must have sold it, so therefore you owe us, right?
Oh, wow.
So yeah, California has what's known as the clawback provision, and this is their way of monitoring it when an investor goes out of state. Now, obviously, if they're living in the state of California, you're still under California, right? It's when you move out of the state of California that they have less control over you other than this particular filing requirement.
Gotcha. Good information there. So we went through 1, 2, what was number 3?
Yeah, the third requirement is the timeline for the exchange, that you have, when you have to identify, you have 45 calendar days to identify the property or properties that you would like to purchase. And I like to say you have an additional 135 days to finish your exchange. So the timeline for the exchange is 180 calendar days, and you have to identify what you're going to buy in the first 45. Now, I'm going to make a little caveat right here because we're getting into that time of year where if somebody is selling and closing on their transaction between, I think it's October 17th, all the way through December 31st, you have to be careful because the code technically reads that you have 180 calendar days to complete your exchange or your tax filing date, whichever is earlier. So if you're somebody that's closing, say, in November, when are we required to file our tax returns? April 15th, right? Or some date around there. Well, your 180 days may be beyond the April 15th date. So you would have to file an extension on your tax returns to get the full 180 calendar days. So it's the conversations, toward the end of this month to the end of the year is going to start getting a lot longer when we talk about the timeframes for the exchange.
Yeah.
These timeframes, just so you know, are statutory and there are no extensions. Now, with that being said, currently the IRS has granted extensions for those people that have been affected by Hurricane Ian out of the entire state of Florida, North Carolina, and South Carolina. But you have to be impacted by that. So, but other than that, you can't rely on any kind of an extension because they don't exist, okay, unless it's been a presidentially declared disaster and you are impacted by it.
Gotcha. Good to know. So this is where things get interesting as a realtor and as the potential seller of the property. And this question always comes up. You have 45 days to find a property. What happens? Let's say we identify some properties, we make offers on those properties, and then we don't actually open escrow on them. What happens then?
Okay, so what you're describing is something extremely common and is something very nuanced and sometimes can be very confusing. So first of all, let me just explain that there's a technical aspect to identifying a replacement property or properties in an exchange. we have an identification form. So it's a form that the taxpayer doing the exchange will fill out. That form generally gets filled out closer to the 45th day because of what you've just mentioned. So you're out there making offers on properties, and maybe the offers aren't getting accepted. Maybe you do have one that's accepted, you do your inspections, and you decide you're not going to buy it. So those are properties you're not going to put down on the form. That's why you want to wait to fill out the form when you get closer to the 45th day. So hopefully by that point, you'll be in contract with the property and feel very solid that that's the property or properties that you're going to be able to close on within the exchange period. Okay, so just to be clear, writing offers is not the identification itself. It's the form that gets filled out that is going to solidify and memorialize what it is you're going to be purchasing as a part of the exchange.
Yeah. So let's say you're on the 44th day, you open escrow on a property, but now inspections start. What happens then if you want to back out of the property? Are you able to? Is there any way out of that 45 days? Or is there, can you identify new properties after that 45 days?
Okay. The answer to the question you just asked is no. So what would be important is that if you do get in contract, say, for example, of a property that's within, say, on day 44, and then obviously it's going to take you a while to do your inspections, you might want to put a couple of backup properties, okay, in there just in case something goes wrong. Now, with the backup properties, you have to hope they're available
Yeah.
when you go to make those offers, because you cannot, once you fill out that list and now you're past the 45 days, there's no modifying that list. You can only purchase property that's on your list.
Gotcha. Yeah. So that's where things get tricky, right? That's where it's like it's 180 days, but is it really 180 days? Because
Well said.
escrow takes not, it's not very often that an escrow will take that long to 120 days to close, or 100 and whatever it is. So yeah, so when people need to think about this, it's once I close escrow on my property, I must get into something immediately. Like we should be boots on the ground. And that's why I've had a lot of buyers who come to me desperate for a property at times. Where like, Sean, we need this house. We don't have any option. We don't care if we pay, maybe $20,000 over what the potential market value is. We just need it because we're going to avoid, $100,000 in potential taxes. So get us in, we're okay. Okay. So yeah, that's where things become tricky. So that leads me into another topic, which is reverse 1031 exchanges, but we'll talk about that in a little bit. You've gone through the 3 requirements. What's the 4th?
The 4th is actually the formal identifying. So I kind of hit 2 with in the same comment. Gotcha. Is that you have to formally identify what you're going to buy. All right. So if you don't do the identification form, then you're not deemed to have identified the replacement property. So that's the 4th major requirement is the timeline and then the formal identification. So those are your 4 basic guidelines for the 1031. Let me just pivot back for a second what you were talking about, because you're right, 100% accurate. The hard part to the exchange is going to be the first 45 days. Now, you want to make sure that when you're entering into this kind of a transaction, that you're not going to go take a vacation to Italy for when your escrow closes. All right. You've got to stay engaged. I like to call it your new full-time, part-time job. All right. Because it's very serious. So now sometimes what people might do to help, mitigate the potential issue of not getting suitable property in time is that when you feel you're at a spot with your relinquished property in escrow and the buyer has removed all contingencies and you feel confident that this buyer is going to perform, there's not going to be any kind of hiccups with the closing, you technically can get in contract with the replacement property, okay, while you're still in contract with the relinquished property. But you have to feel very confident that your buyer is going to perform and that you're going to close on your purchase after your sale has closed. So this is one way that sometimes people mitigate, that issue with the 45 days. So that's just one way to kind of, hedge your bets, if you will. But you just need to be very cognizant of what's going on and how solid the transaction happens to be.
And you need a great realtor like
You
myself, right?
do. Yes, exactly. You have to have somebody, and you've got a great handle on it. So, yeah. So working with someone like you to do this, I mean, you understand what's going on, and like I said, you described it so well. While you have 180 days, the first 45 is the tough spot. So you got it dialed in, and I like that. I
Yeah.
like that. I will tell you there are occasions where the 180 days does come into play, and that's when people are buying new construction.
Mm,
So
yeah.
that's where the 180 days can really come into play, because material shortages, labor shortages, whatever can delay the completion of new construction. And
Oh,
I've had exchanges that have failed because they couldn't get the closing done by the 180th day with new construction acquisition.
yeah, that would take some very creative stuff to close on that before the house was completely built. So,
Mm-hmm.
yeah, I mean, I've had clients even prior to the pandemic where there was no shortage of materials.
Mm-hmm.
They just simply were behind. And if they
Yeah.
were in a 1031 exchange, fortunately, they didn't have any tax liability when they sold their property, because it was their personal residence and
Gotcha.
they got a capital gains exemption. So they
Mm-hmm.
were 100% clear of that. However, if they were doing a 1031, they would have lost, and that would be interesting because I'm sure these builders have clauses in there that protect them as well. So my suggestion from my experience, I don't know if that's necessarily the best route going after new construction, unless they're like on the 90% line and they're like right there. Even then, I don't know. It's, could be skeptical, but you bring up a good point of when that would happen. So
Yeah, I think your words are very wise. Yeah. Hmm.
very cool. Very cool. So, yeah, so we have the concept of, we have this property. It's gone up in value by, let's say, here in California. I mean, it's not too far fetched to say $1 million. So if capital gains tax, what if it's at 20, 25%, whatever it is, plus state income tax, which is 12%, there goes 300 and something $1,000 of the income from the property if you were to just sell the property. So
Hmm.
what I always advise clients is like, what if we could do a 1031, avoid the capital gain, get into something that has more depreciation value because of the higher analysis on the new purchase price.
Hmm.
Then, if you want, you can refinance out of the property, pull cash out of the property. No loan is taxable. And then you could take that money and go use that, whatever you were looking to do. We've avoided, currently, we didn't really avoid, we're prolonging the taxes down the road. But I've always thought of that as an idea of things that you could do as
Hmm.
well. So,
Yeah, so you're basically talking about refinancing any kind of replacement property that you've acquired in an exchange. And it's going to get, and right now, and I'll say under current tax law, you notice I keep saying that
yeah,
because you
yeah, this
never know
could
what
change.
Congress, you never know what Congress is going to do, right? I mean, they talked about mark to market and stuff like that, which is a nightmare and a half. But so right now, investors, they can pull out the equity from their investment property and not have any tax liability to it. So there's a couple of things when you're talking about the strategy that you're describing. So they go off and they buy the replacement property in an exchange, and then subsequently they go refinance, pull the cash out. Well, there's two things that I think you need to be aware of. One, when should you be doing the refinance, right? So you want to talk to your tax advisor to determine how soon should you be pulling out any cash from it when you've done an exchange. I will tell you your exchange needs to be completely over before you even fill out a loan application. Some tax advisors might want to wait for you to season that ownership for maybe, 3 months to 6 months. Now,
Six
a lender
months
may
is
have it. Yeah.
typically, yeah.
Yeah. A lender may have its own opinion, right? A lender may go, well, no, no, no. We're going to make you own it for a year. So you've got different views, one from the lender, one from your advisor. And then the other thing, just to be aware of, when you're going to do something like that, depending on where you're spending your money, where does it interest get deducted? There's a thing called the tracer rule. So, make sure that when you're doing this, and if you were going to go off and buy a boat or a plane, you might want to check with your accountant as to where's that interest going to be deducted. Okay, is it going to be, can it be deducted off of the property? Or does it have to be deducted somewhere else? So these are very nuances that I think it's important that when you're considering something like that, you talk to your tax advisor about where that interest deductibility is going to fall on your tax return.
Absolutely. And I'm not a tax advisor, so talk to your guys' tax advisor for sure. So, yeah, there's so many aspects to the tax law. There's so many different avenues you can go, and I'm glad to have you here to at least talk about one of them. Um, I would love to go into reverse 1031 exchanges because we're kind of coming out of this market of like 15, 20 offers on every property. There was a half a month of inventory. Recently inventory has loosened up to about 3 months in my area.
Okay.
So things have calmed down a lot. Interest rates have gone up almost to 7%. So this has backed off demand quite a bit. And so now it's not so much of a concern. And yet at times it can be a concern to find the right replacement properties. So if somebody is looking for something very specific, I think talking about the reverse 1031 is important. And can you go into the basic idea and then maybe any little nuances that you want to mention would be great.
Definitely. Okay, so a reverse exchange, basically, it means that you have to close on the purchase before you've closed on the sale. So just to nail the point home, if you just get under contract with the replacement property before your property has sold, and the purchase closes after the sale, that's not a reverse. That's just good timing. But in a reverse, and as you described, and we saw, and we still do right now, actually see a decent amount of reverse activity because people want to capitalize on closing that replacement property because that takes away that angst about the 45 days. That's why, people consider the reverse exchange. Now, when you're doing a reverse exchange, the couple of things to keep in mind. Not everyone is going to be able to do one, even though they're available. So the first question I will ask if somebody's considering a reverse exchange is, where are you getting the money to buy the property? Because in a forward exchange, you've done what? Closed, have cash, and can go out and buy. In a reverse exchange, you don't have the cash from your sale because it hasn't closed yet. So where are you getting the money? That is going to be the determining factor about whether you're going to be able to do a reverse exchange or not. So what happens is the taxpayer cannot be on title to both properties at the same time. So for example, if you're selling your property and then you go off and you find this replacement property, you go, okay, I'm going to have this, Sean, I'm going to be on title to both properties. And then when my sale closes, then I've got my reverse, my exchange. No, you don't, because you can't exchange in a property already owned. So when there's a reverse, we as the qualified intermediary create an LLC where we're the member of the LLC and we physically go on title to the property. Now, so far, so good, right? Well, if you have all cash to buy the property, then it's not an issue because there's no financing involved. But if you have to go out and get a loan through friendly lender, so a conforming lender, I can tell you 99.9%, you're not going to be able to do a reverse because what happens is our LLC, so the Qualified Intermediaries LLC, is going to initially be the borrower. Now, our LLC only has this piece of property, all right? Now, you as the taxpayer can guarantee the loan, but we're going to ask the lender to add language to their loan documents to say that you can never, ever, ever, never, never, ever, ever come after asset preservation for any defaults or any bad actor behavior with the loan that the ultimate borrower will have. And this is where it always comes to a complete halt. Okay. Now, there may be lenders out there that are going to be willing to finance this because they understand it. It's going to be a little bit more costly. So when you think about a reverse exchange, while it gives you an opportunity to tie up that replacement property and close on it, it's a more expensive exchange because of what it is. So the fees for an exchange go up exponentially. Then you have, if you've got to go out and get specialized financing, that's going to cost you more. And then there's a potential for double transfer tax and such. So anytime somebody's considering a reverse exchange, I always like to go through the economics. So what I would do is say, okay, what property you're selling, how much would you be paying in taxes on that property? So if I find out that they're going to pay maybe, $20,000 in taxes, I'm not thinking a reverse exchange becomes economically feasible for them because it's a very expensive exchange. But if their tax liability is $100,000, then this now starts making more sense, right? So what are my benefits to it? So anybody considering a reverse really needs to have a discussion well in advance before they start making any offers and locking themselves into anything to make sure that it's something that they're going to be able to accomplish. So, they're not, of all the percentages that we do of exchanges, we probably, of everything that we do in a month, reverses are usually 10 or 15% of what we do in a month because they're just not, most people can't do it because of the structure.
Yeah. So basically, what I'm hearing is that if you have cash in the bank already, it's going to be a lot easier to accomplish this. Number one, because no lender is involved and the way that you hold title is not going to be an issue. And then number two, even if you don't have the cash and you are getting financing, finding the lender that will do it, it's going to be more like a hard money loan or a non-QM, what we call non-conforming loan and typically, like you said, those are more expensive.
Right.
So
exactly.
Well, that's a ton of information. That was, my head spinning. No, not really, but I'm
No,
sure.
your head's not spinning. You got a good grasp of this, young
No,
man.
I'm just kidding. But that for someone hearing this for the first time, they're like, are we talking English here? So but if they have any questions, how do they reach out to you? And you're the 10 for everyone to know, 1031 accommodator is necessary in order to make a 1031 exchange happen. And you are a 1031 accommodator. So how would they reach you?
Yeah, you can reach me. My office number is 866-857-1031. So 866-857-1031. My cell phone is area code 310-508-7367. So cell is 310-508-7367. And you can always reach out to me via email. And that's my first name, which is Dino, Dino, at apiexchange.com. So happy to field any questions that you might have. I know we've covered a lot of ground, but I can promise you we haven't covered every scenario with the 1031. And everybody's situation is slightly different than the next guy. So,
Yes, absolutely.
feel free to reach out with any questions you might have.
Yeah, you're the master. So I appreciate you. Thank you so much. I appreciate your time,
My
and
pleasure.
we'll be in touch in the future.
You got it, Sean. Thank you so much for having me. I truly appreciate it. And good luck
Absolutely.
out there. Okay.
All right. Thank you. Take care.
My pleasure. Take care. Bye-bye.